So with chapter number 1, what we're going to do with chapter number 1 is we're going to look at, it's a general introduction to accounting, but what I'm going to look at here really is who are our users of financial information, who are our users of accounting information, what are they looking for, and what are we trying to achieve. So it's a reasonably short chapter which allows me to just give you an introduction as to why we bother with these types of accounts and why we bother with these types of financial statements. So we start off with an introduction which is a definition. And the first thing I'm going to think about is what actually is accounting all about? Well, accounting is all about providing financial information to users so they can then make some sort of decision. So I'm going to try to provide financial information to users so they can then make they can make use of that information and then make a decision. So what I'm thinking about now is what type of information do I need to give them, what type of users are going to use this information, and what type of decisions are they looking to make. So what we're going to do is we're going to go through and identify some of our users. Every time we look at these different types of users, think about what information do they want, and then think about how can I potentially provide that to them. That's the really important aspect of accounting. The core driving force behind everything that we do as accountants is trying to allow people to make the right decision. So we're trying to make sure that somebody can make the right decision. So what this now means is I need to give them the type of financial information that they can understand. So I need to make sure that I can give them information that I can understand. What we do to ensure understandability is we have certain key formats for all of our different sets of financial statements, which everybody's supposed to follow. If you follow that same format, and every company in the world has got the same format, I can now look at any set of financial statements and then hopefully understand them. Does that make sense? So a bog standard normal format will allow everybody to understand everything which is going on. Now I've been talking about financial statements. Financial statements are the things that you'll probably come to a bookkeeping course and expect to be taught about, and that's what we're going to really focus in on today. From a financial statements perspective, I'm looking at generally external users. So from a financial statements perspective, I'm looking at external users, so people outside of the organisation. So I'm looking at maybe investors, maybe shareholders, maybe banks, maybe suppliers, maybe customers. All of these different parties will have an interest in what's going on within my company. There's another set of users here, which are my internal users, which will be the management. The internal managers within the organisation, they need management information so they can produce management decisions. We need them to make good quality decisions, so we need to give them up-to-date information and then also potentially future forecasts of what's going to happen. That's the management accounting role. So if you've got a management accountant within your organisation, that management accountant's job is not just to report on what's happened in the past, it's actually try and guess what's going to happen in the future. We're not going to focus in on management accounting within this course, we're just looking at the financial accounting role. Okay? So when I start thinking about the various different types of users that we have, so when I'm looking at the various different types of users that we have, we've got internal users and external users, and when I look at this financial information, I'm not just looking at financial statements. So it's not just a set of financial statements. There's other information out there which is really useful to me as well. And other information such as, in the last week or so, we've had another UK budget. We're going to have, there'll be an impact on the Manx budget next March when that comes out. And that now means that all of that type of information is going to be important to me because I need to work out what's happened to the general economy, to work out whether I think I can make more sales or less sales, maybe build another factory, build some more machines so I can make some more of these fabulous flip chart pens. All of those things have to come into play. All of those things will influence various different users' decisions. Okay? So it's a huge, wide range of information that we can potentially use from a decision-making perspective. All we're doing is we're focusing in on one piece of the puzzle. And always remember that, guys, this is just one bit of a huge decision-making process that people will go through. So what we've got is various different users, and you can actually follow this quite easily within your packs as well. I tried to make it flow through in the same way. So we have managers. Managers are looking to manage the business on a day-to-day basis. That now means that they will need up-to-date current information. So they will need up-to-date current information so they can make decisions today. So I need to be able to make a decision today. These types of managers will have different types of decision-making time horizons. That now means that my decision will have an impact over a period of time. So my decision will have an impact over a period of time. And what we say is we've got 3 different layers of management. You've got strategic management, which look at longer term pictures. You've got tactical management, which look at medium term pictures. Then you've got operational management that look after the day-to-day stuff. Okay? Operational management need information based on what's happening today, and I need that now. So operational management need that information immediately. I can't do that from a bookkeeping perspective. This is not my financial accounting role. That's the management accounts role. That's a different style of accountancy. We're not looking at that style of accountancy today. Okay? Owners and shareholders are another key user group, and from a financial reporting perspective, when I produce my financial statements, what we say here is the owners, shareholders are the key group of users. So they are the key group of users. The main reason for this is the objective behind every set of accounting financial statements is to report on the stewardship of the directors. So we're reporting on the stewardship of the directors. Okay, Ed, what on earth are you talking about? Well, what this basically means is we've got a company, and the company will perform various different activities, it will perform various different transactions. The company will make a profit or a loss. The company is actually run by the directors. The company is owned by the shareholders. These 2 different parties can be completely separate people. What this now means is when I produce a set of financial statements, what I'm actually doing is the financial statements go to the shareholders, but it really reports on what the directors have been up to. Does that make sense? So we have this concept of stewardship accounting. And what it means is the directors are acting as the stewards of the shareholders' assets. So the directors are reporting on how well they've looked after the shareholders' assets. Does that make sense? That's the whole concept of financial statements. That's why we produce these things called accounts. Now, if you look at a set of financial statements, and I would seriously encourage you to look at sets of financial statements, what you'll find is there's not just a big scutch of numbers in there. There's lots of other, what we call narrative reports, which will allow you to see exactly what's going on with the organisation. They try to make it nice and simple to understand exactly what we're up to. Okay? So it's not just the idea of putting some numbers together, there's also words in there, and usually lots of pretty pictures, which illustrate exactly what we're up to. All of that information is really useful for my owners' shareholders. So all that information becomes really useful for these guys. That type of information is useful for almost every single organisation to produce because there's always some sort of ownership interest which is interested in what's going on. Okay? Now I've been doing some work with Manx Utilities over the last couple of months. We had a look at their strategic positioning and such and tried to give them an understanding of strategic management and how they can potentially change different things to increase their profits, increase their profile, etc., etc. And what's potentially happened here is if you look at their financial statements are about 80 pages long, 80 pages. There's about 6 pages of numbers in there. The rest of those pages are all words and pictures. Okay, so the story they're trying to get across, only part of the story is told in the numbers. The rest of it is told in the pictures and the words. Okay, so again, even from a financial statements perspective, we're only looking at one small piece of the puzzle here from a bookkeeping perspective. So when I process my debits and credits, this will allow the numbers to be produced. This doesn't necessarily produce the words or the pictures. Okay, does that make sense? It's funny actually, because one of the things we said was they need to have a marketing focus, and now that's what they're looking at. Okay, we happy with that, guys? Other people who are potentially interested in this, providers of finance, the banks who give the companies loans. What are the banks interested in? Are banks interested in profits? No. Banks are interested in cash flows. So what we do within a set of financial statements is you have a statement of financial position, which is also known as a balance sheet. So a statement of financial position, also known as a balance sheet, which says, this is my current position. So this gives me a list of all the assets and liabilities. Then what you've also got is a profit and loss account, also known as an income statement. So you've got a profit and loss account. And what that does is it tells me the profits or losses over a period of time. That gives me a performance statement. What we also produce is a cash flow statement. Show me where cash is being consumed and where cash is being produced from. The banks are really interested in that. So the banks will look at that type of cash flow statement and they will say this is particularly useful to me. So the banks will look at that type of cash flow statement and say that's interesting to me because I'm only interested in cash flows, I'm not worried about profits. Okay? A large number of companies can make a loss and yet still service bank loans. We're completely comfortable with that. In the same way, companies can make profits and still fall over because they don't have sufficient cash. Banks wouldn't be happy with that. Great example of that's Carillion, which fell over earlier in the year. They were still making profits even until they fell over, but they had no cash. Okay, so poor short-term cash management, which would have been focused in on by these providers of finance via a cash flow statement, was something which has brought the entire company down. Okay. Other users of our information would include people such as everybody's favourite, the tax guys. And we will have a look at some of the tax elements a little bit later on, so we can focus in on corporation tax issues or income tax issues. And then if you want to have a look at some VAT stuff, we can have a look at some VAT issues as well. So the tax authorities need to be able to collect their pound of flesh from us. What they do is they process various different adjustments to our profit figures to try and make it a taxable profit. So the profit figure that we produce within our financial statements is not the figure that gets taxed. There are adjustments. And those adjustments can be very convoluted and very complicated, which is why we always suggest you get some sort of professional tax advice to make sure it's correct. Okay. Suppliers and also customers are potentially interested in what's going on here within our organisation, because my suppliers need to make sure that I am I have the ability to potentially carry on buying stuff from them in the future. So from a supplier's perspective, they want to make sure they can keep on selling stuff to me. So they want to survive, therefore they want me to survive too. Financial analysts are interested here because they will give advice to people. So they'll give advice to potential shareholders, which will be buy or sell or hold those shares. So it could be a buy or sell or hold with regard to shares. Okay. The government, believe it or not, are amazingly interested in these types of financial statements. Not necessarily the government on the Isle of Man, because we don't collect this type of information on the Isle of Man, but other jurisdictions, such as in the UK, there is a huge database computer system within the Home Office in Whitehall. And what they do is they plug in all the financial information they can potentially find from everywhere. And on that basis, they now work out where money should be spent. So what you've got from the financial information perspective, you've got the tax authorities taking money in, you've then got government working out where money needs to be spent. So they will now spend money on potentially new roads. They'll spend money on potentially putting in some new infrastructure, so they'll be digging up Duke Street at the moment, putting in some new drainage and such. So there's all these different things have to apply. The government are there to try to give us an environment within which we can operate from a business perspective as well as live in from a cultural perspective. Okay, so government's role is quite nasty here, it's quite difficult to fulfill. There are other people who are potentially interested in what goes on here, and the other people who are potentially interested in this will include your good selves, because you're all employees of organisations who will produce this type of financial information. What do you want from your employer? What do you want from your employer? I want to have a salary over the short term. Hopefully there's going to be increases in that salary over time. So I want to see increases in my salary. So I need to make sure that my employer is a stable employer. I need to make sure they're going to be around for a while. Also, what I'd potentially like to see is some sort of career growth, maybe some sort of development as an individual. All of those things come into play as well. You need to make sure that the company you're working for is going to be stable enough to be able to do that. One of the ways you can view that stability is through the financial statements. Okay. When we get our various different accreditations from the ACCA, ICW, and ICSA, they actually look at our financial statements to ensure we're financially stable. So the accreditations that we have are actually reviewed, are actually going to use our financial statements to review to determine whether we're stable or not. Customers will potentially look at financial statements. No, they don't. What tends to happen is the newspapers will look at financial statements and then report to customers on what's going on within different companies. And then last and by no means least, you've got things such as the general public. So as a for instance, I'm interested in the financial reporting results of things such as Sellafield, BNFL, British Nuclear Fuels, because they've got that big nuclear power station just over the water a bit. I need to make sure they've got enough money to keep it safe. I don't want it going boom and taking out half of the island. Okay, so that's the type of thing I'm potentially interested in as well. So all of these different aspects, all these different users have very specific requirements. I need to make sure that I can fulfill their requirements by producing some sort of financial information. The financial information that I'm going to produce will be in two main forms: financial accounting information and then management accounting information. So financial accounting information and then management accounting information. We're going to focus in on the management accounting information on a different course, and we're going to focus in on the financial accounting information on this course. Okay, so management accounts is a separate day, financial accounts is this day. Yes?
Is financial accountant like F3 and then management accountant F2?
Mm-hmm.
Right, okay.
Exactly that, yeah. Okay, we happy with that so far then, guys? Fantastic. Right, we're going to start off by looking at financial statements then. So we've had a general background as to why we're doing all these different types of things. So let's have a think about what we actually end up wanting to do. We're going to produce a statement of financial position, and then we're going to produce a profit and loss account. Is this going to be useful for me? The statement of financial position, which is the international term for something that you may know as a balance sheet, which is the UK term. It doesn't bother me which term you use. Okay, so statement of financial position or a balance sheet, they both denote exactly the same piece of paper with the same numbers on it, just the ordering of the numbers is slightly different, and we'll look at that a little bit later on. So it's the same type of statement. What this does is it tells me where the company is at a specific point in time. So that tells me where the company is at a specific point in time. The profit and loss account is a key performance report. So the profit and loss account is a key performance report. And what this does is it shows me how much profit I've made and then the costs associated with making that profit. So it tells me total sales. It then tells me how much those sales have actually cost me to make and then make the sale from. And then also gives me other elements of expenditure. Okay? We're going to go through those key financial statements in much more detail within chapter 2. But from a chapter 1 perspective, all we're looking at is these are our two key financial statements. And what we're doing today is we're going to go through lots of different bookkeeping, which will allow me to produce these key financial statements. Okay? Any questions or queries on that so far, guys? So that brings us up to the end of chapter number 1. Right, so let's have a look at chapter number 2. Within chapter number 2, what we're going to do is we're going to look at these key financial statements. Now, the two statements we're going to focus our attention on will be the balance sheet or statement of financial position, and then also the profit and loss account, also known as the income statement. So with the balance sheet, Harrison, are you okay?
Yep, sweet.
Okay. So what we've got is a balance sheet. The balance sheet details all of my assets and liabilities. So the balance sheet details all of my assets and liabilities. This now means that this type of statement of financial position is effectively a financial camera taking a snapshot at a specific second in time, and it will just list all of the assets we have and then all of the liabilities we have. So it'll list all of the assets we have and then all of the liabilities that we have. What it also does is it will denote an ownership interest. And the ownership interest is denoted via the capital accounts. So the ownership interest is denoted via the capital accounts. Okay? And what we're going to do is we're going to go through these various different elements of financial statements, these assets, liabilities and capital in a little bit more detail. And we're going to go through some definitions of them. We're going to show you how we actually work out what these things are. We'll actually talk to you about how we value these things as well. Okay? So that's my balance sheet or my statement of financial position. And what will happen is we will have a year end of, for instance, 31 December 2018. As at 12 o'clock midnight on New Year's Eve, on the 31st of December 2018, we look at all of the assets and all the liabilities at that specific second. This is why any auditors will have not usually a very good new year, because new year becomes very busy for them. You may end up having to do some sort of stock take. If you get the opportunity to do stock takes, do the stock take at the ice cream factory, because there's always lots left over, which means you're always welcome at any party afterwards. Not that I know that from experience, of course. From a profit and loss account perspective, my other key financial statement, What this is going to do is this will give me all of my income and expenditure. Income will be things such as sales. So income will be things such as sales. Expenditure will be amounts of money that I've had to spend to make sure I can make those sales. And what this does is it gives me my two key financial statements. We've got my statement of financial position on my balance sheet, which tells me where I am at a point in time. And then what I've got is my profit and loss account, which is a performance statement, which tells me how well I've done over a period of time. These two key financial statements come together in this very, very simple structure. So what we have is last year's balance sheet will be linked to this year's balance sheet via this year's profit and loss account. So what you can do is you can think of the profit and loss account as the story which is taking me from one point last year to one point this year. So the profit and loss account is the story which takes me from last year's balance sheet to this year's balance sheet. What you can also do, and you'll cover this within studies if you're doing FFA, you can look at things such as the accounting equation, the business equation, which says assets and liabilities last year plus or minus all of this profit or loss must equal assets or liabilities at the end of the year. So your brought forward figures plus or minus your profits must equal your carried forward figures. Does that make sense? So what this now means is we can potentially reconstruct different parts of our financial statements as long as we know other bits of the jigsaw puzzle. So as long as we know bits and pieces, then we can work our way through the vast majority of the rest of the bits that we haven't yet got. Okay, we happy with that? Fantastic. Right, what we're going to do is we're going to have a look at various different component parts within our financial statements. And what we're going to do is we're going to start off by looking at the idea of gains and losses and then contributions and such. What we've got is a contribution from the owners will be an addition to capital. So a contribution from the owners will be an addition to capital. And what this now means is my shareholders put money into the company. So my shareholders are putting money into the company. This usually comes about by the shareholders buying shares. So this will normally come about by the shareholders buying shares. So the shareholders or the owners can make contributions to the company. And what will happen is all of the money that they put in will now be represented by an asset. So the money that they put in will now be represented by an asset. Okay? So what we've actually got within our balance sheet, within our statement of financial position, is assets and then liabilities, and then we've got the capital, which is my ownership. What effectively happens is, as my owners put more money in, the capital will now increase. So as my owners put more money in, the capital will increase. As they put their money in, that means my assets will increase as well. This now allows me to start thinking about double entries. So there's a double whammy effect to every single transaction. So if you put more money into the company, your assets increase because the company will now have more money. However, the ownership interest will now increase as well because your shareholders will now have more shares. Does that make sense? This actually ties back to our story of the profit and loss showing the movement between one balance sheet and the next balance sheet. Last year's balance sheet will be a list of all of the assets and liabilities. Last year's balance sheet of assets minus liabilities will also equal the capital amount. Okay, so we've got debits and credits. We'll come to the debits and credits element in just a second. But these debits and credits will now tally up. What also now happens is if you have profits during the year, that now means that your assets minus liabilities have increased. So assets minus liabilities have now increased. So profits during the year are good news here because the value of my assets will go up. Profits during the year are good news here. So profits during the year are good news here because what will happen is the ownership value or the ownership interest will go up as well. Okay? So you've got an increase here and then you've got an increase there. This is what's known as my accounting equation. And what this now means is I can represent this algebraically. You remember when you went to school and you said, oh, I'm never going to use algebra in the real world? Here we go, we start using algebra. This is as far as we're going to go with it. And what this basically says to me is, if debits equals credits within all of my different financial statements, so if debits equals credits within my financial statements, what I can now say is asset values, which are debits, so asset values, which are debits, equals the liabilities, which are credits, plus the ownership interest, which is my capital, which are also credits. So debits equals credits, which is why I've lined it up this way, so the equal sign sort of comes down more or less in the same place. So debits equals credits says assets equals liabilities plus capital. What that now means is we need to have a basic understanding of what this capital is, and then we can start thinking about how the debits and credits will have an impact on both things. Now, assets and liabilities, we're going to go through the definition of those in just a second. The capital that we have, so capital will be share capital, which will be share capital introduced. We also have share premium, which is an amount introduced over and above a certain amount. We also then have retained profits. These retained profits, so these retained profits are effectively my accumulated profits since incorporation. So this retained profits is my accumulated profits since incorporation. And what this shows you is every single time the assets increase in value, the assets increase because we've got more profits. So the assets become my debit, these profits become credits. So what I can do is I can dump in some debits and credits in here now. So assets are debits, liabilities are credits, share capital is a credit balance, share premium is a credit balance, this retained profit figure, that's a credit balance as well. And what my balance sheet or my statement of financial position does is it basically says debits equals credits. Okay, so it just says debits equals credits. And depending upon whether you're using a UK format or whether you're using an international format, that just changes the order of this organisation. That's it. So the way I've actually listed these things down here, this is our bog standard UK version of a balance sheet. You just list all the assets, then list all the liabilities, subtotal it. You then just list all the capital, i.e. all the ownership interest, and then subtotal it. This subtotal must equal that subtotal. That's it. That's all your balance sheet does. And then what happens is as you make more profits during the year, our profit during the year is an extra credit balance. So retained profit during the year is an extra credit balance. That means that assets have increased during the year because we've made some gains. That means this retained profit figure increases. So your debits go up because you've got more assets. Your credits go up because you've got more profits. Does that make sense? And that's the dual nature of every transaction. Are we happy with that so far? Any questions on that? No? Cool. Okay. Now, what this means is we need to have an understanding of what an asset and a liability is, because if we understand what an asset and a liability is, we can then work out whether there's any types of gains or losses on those assets and liabilities. And those gains or losses in assets and liabilities will now have to be reflected probably within this retained profit moving over time. So increases and decreases in these assets and liabilities will have a knock-on effect within my profit figure. Okay? So what we can do is we can actually have a definition of assets and liabilities. And the definition of assets and liabilities focuses in on 3 key areas. So it focuses in on 3 key areas. What we have to start with is a past transaction or event, which means that something's happened. So a past transaction or event. That past transaction or event will generate what we call future economic benefits. These future economic benefits should really be seen as cash flows. And those future economic benefits are under our control. If I meet these 3 criteria, I now have an asset. If I have a situation whereby I can determine the future cash flows from an asset, and the future cash flows from an asset are now going to increase, that gives me a gain. That gain in my assets will have another credit effect, which is going to be an increase in my profits. There's the double entry whammy. So a debit to an asset increases the future economic benefits, so it increases the value of the asset. The credit figure then goes into my profit and loss account, which increases my profits, which then means that my balance sheet will still balance. Does that make sense? So the debits and credits we're going to be processing very soon will have an impact on my statement of financial position on my balance sheet, and then also on my profit and loss account. Okay? Always think about the double whammy impact as we work our way through this. Okay? So, what we have are various different assets and liabilities, then we have our ownership interest. The ordering of these different assets and liabilities is absolutely critical to anybody's understanding. So the ordering of these debits and credits is critical to anybody's understanding. If you were to play around with the ordering, it's going to take me longer to work out what's going on. So what we do is we give you very, very simple structures. So we give you very, very simple structures. And what I'm going to do here, guys, is I'm going to talk you through the structure of the ordering of these things and say, here's the UK version, here's the international version. So you can see that there is a difference, which now means that when you look at this one piece of paper, you can work out what type of accounting standards these people have used. Okay? I don't want to get into a huge detailed discussion of accounting standards because we don't really need that here. But understanding what these financial statements are trying to say and how they say it can be very important to me. So if I was to look at an international version, which will be my statement of financial position, notice the way I've shortened this down to SOFP because my typing is not great. What that now means is I have assets up at the top. That gives me my total in terms of debits. I will then just simply completely total that down. So that total of debits just gets cast down. Then what happens is I have my capital, which is my ownership interest, which will be credit balances, which will be share cap, share premium, retained reserves. So all of these different things we looked at before, they get listed down next. They will normally be subtotaled. Then we have our liabilities. Those liabilities are also credits. We then subtotal all of these down to give me my total credits. Okay? So this is an international standard version of my statement of financial position. So this is the international version of the statement of financial position. Okay, we happy with that, guys? Now you can go back to your organisations tonight, tomorrow and such, and actually have a look at your own balance sheet or statement of financial position. And if it's done in this order, it means that you're using international standards, which means that you count your beans using international rules. Okay, so you count your beans using international rules. If you have got the UK version actually splits this down to a little bit more detail. And what it does is it looks at long-term assets first, then it looks at short-term assets. So they're going to be debits. They're going to be debit. Doesn't total them down yet. It then looks at short-term liabilities, which will be credits, and it now comes up with a net total. Put that across there. So we now have a subtotal here, subtotal, which is net current assets. Current means short term. What we then do is we have an overall total for the top part of my statement of financial position or my balance sheet. Then what we do is we look at the bottom bit, which will be my ownership interest, which is capital, which will include share capital, share premium, and then retained reserves. All of these are credit balances. And that then gets totaled down as total for the bottom. Okay? So if you've got This type of structure, it means you're using UK standards. Does that make sense? Now, it doesn't matter whether you like the UK one or the international one, they give you the same type of information just in a slightly different way. Personally, I quite like the UK version because this figure here for net current assets tells me whether the company's going to be still afloat in 12 months. And if it gives me that information immediately, I think that's actually quite useful to me as a user. Okay? So even when we put our own financial statements together, we use international standards to value everything. We actually use the UK version of it with regard to the ordering. Okay? So when you hassle Sarah about the financial statements at the end of the year, the accounts, you'll see them in this order, but she's counting her beans on using international standards. Okay? If you were to look at your organisation as a for instance, you'll probably find that you'll use international standards because it's a big international organisation. However, you may find that you use a different structure. I'm comfortable with people using any structure at all. As long as my users understand what's going on, I'm completely happy with that. Okay, so as long as people understand what's going on, I'm happy with it. Because my core objective here is not to try and bamboozle you with science. My core objective here is to give you information which is understandable so that you can then make a decision. If you can understand what's going on and you can then make a decision, my job as an accountant is now fulfilled. I've now done exactly what I needed to do. If I give you information and you don't understand it, I've now failed. Because my job is to give you understandable information, I haven't done that. Okay, that is absolutely critical to me as an accountant. Okay, are we happy with that so far, guys? So what that means is the structure may potentially change. The way that the totals come down will potentially change. And we're actually going to have a look at this in a bit more detail later on when we look at a full set of financial statements. So the number down at the very, very bottom may change, but the way that we count our beans should still be pretty similar. So the way that we count these numbers up should still be pretty similar. Okay? The profit and loss account, there is an international version and a UK version of the profit and loss account. The great thing about the profit and loss account is it's basically the same. So UK version or international version, I care not. They are basically the same ordering. And what happens here is we look at our core trading activities. These core trading activities will give me what we call our gross profit. So the core trading activities will be sales or turnover or revenue, same word, same thing, just with different phrases. So sales or turnover or revenue minus cost of sales. That gives me my gross profit. If that gross profit is positive, then it looks like I might be in the right business. If the gross profit is negative, you have a gross loss, you need to sack your directors because they're doing something seriously wrong. They're in their own business. They don't understand how this business works. Oh wow, that then gives me a decision as a shareholder to make immediately. Do I want to keep those directors? Do I want to remove them? So there's a decision straight away from that one figure. Okay, that means that information is amazingly useful to me. Then what happens is we take off any other type of costs such as admin expenses, distribution costs, which have to be incurred to allow me to make those sales. That then gives me operating profit. If you've got a gross profit and then you've got an operating profit, I'm actually happy with that because it means things are looking pretty good. If you've got a gross profit and you've now got an operating loss, you've got too much admin expenses. Sack off the admin team. There's a management decision. Again, I'm using this information to make decisions. Okay? So these type of decisions come straight from the financial statements. And this is why when you look at things such as Debits this last couple of weeks, they've now completely started to restructure their organisation by closing a certain number of department stores and sacking loads of people because their operating losses are too great. They might still be making a gross profit, but the operating losses are too great because their rent payments are too high. Okay, we actually analysed Debits as a business model in one of our advanced strategic management classes, and Debits have not done enough yet to survive. They've still got some big changes to go through. And you can actually look at what's happening within their financials and say, that's wrong, you need to make this decision. And they're starting to implement those decisions, but they haven't got to the end of that road yet. Okay, so there's still some big changes in there. Now that's really scary because I don't work at Debenhams, but I can look at the financial statements and say, there's the problems, here's the decision which has to be made. Managers go away and make that decision. And they're now starting to do that. Okay? So that now means that me as an external user can understand exactly what's going on within that organisation. That's really important to me. Okay? Then what happens is further on down within my P&L account, we look at other non-operational issues such as every shareholder's dream, getting dividends paid out. Dividends come off the very, very bottom. What happens is you get down to your operating profit, you then subtract your tax, you get to your PAT, profit after tax. The profit after tax is the amount which is legally available for distribution as a dividend. And yes, that's a complete mouthful because it comes straight from the Act. So you can only distribute profits that are legally available for distribution as dividends as a dividend. So there's some key restrictions there. And what we're trying to do there is we're trying to protect other external people. So we're trying to protect creditors, people that we owe money to. We need to make sure that we can't just give all of our money away without actually keeping some back to pay these people off. Okay, does that make sense? Are we happy with that so far then, guys? Fantastic. Right, that brings us up to the end of chapter number 2. Now, within chapter number 3, what we look at within chapter number 3 is we're going to start looking at bookkeeping proper. We're going to start looking at debits and credits. We're going to look at how these various different things can be processed. And as we go through these various different debits and credits, what I need you to do, guys, is think about the impact that this thing is going to have on my statement of financial position, the impact that this thing is going to have on my profit and loss account. And notice that there'll be a debit and a credit for absolutely everything. However, the debits and credits may affect different financial statements. So the debits and credits may affect different financial statements. So what we've got is this wonderfully balanced approach, which is why accountants are such wonderfully nice people. Because we're all so totally balanced with regard to debits and credits. So what we have is what we call T accounts. If you hear somebody talking about debits and credits and T accounts, it means that this is an older fashioned version of what's going on. We call these things T accounts because it looks like a T. Okay, that's as technical as we need to get today. So that's a T account. What happens with these T accounts is you will drive on the left. If you drive on the right, you will crash. So we drive on the left, we crash on the right. So we drive on the left, we crash on the right. And what that now means is, when I put together my T account, I have debits on the left, I have credits on the right. So I have debits on the left, I have credits on the right. Okay, does that make sense? So as we go through all these various different debits and credits, what's now going to happen is we're going to start thinking about the impact on my balance sheet, on my statement of financial position, and then the impact on my profit and loss account. So when I'm looking at these idea of debits and credits, we've got an impact on my balance sheet. The impact on my balance sheet will be an impact on assets and or liabilities. So an impact on assets and or liabilities. And what I'm going to do, guys, is I'm going to put this together up here on the board. Are you colorblind? Brilliant. Increase in assets is a debit. A decrease in assets would be a credit. So there's the increase in assets, there's the decrease in assets. The way that liabilities work are the other way around. So you've got an increase in liabilities will be a credit, decrease in liabilities is a debit. Okay, does that make sense? So that's the impact on my balance sheet or on my statement of financial position. What we then have is an impact on my profit and loss account. So what we then have is an impact on my profit and loss account. And the impact on the profit and loss account is based on an increase in expenses will be a debit. If there's a credit figure on my expenses, that means I've decreased expenses. If I have a credit, it may mean I've got an increase in sales or revenue or turnover. So an increase in sales or revenue or turnover. A debit balance across that type of account will be a decrease in sales. Okay? Now what this means is we can start thinking about the way the debits and credits process across now. Because if you've got a good news transaction, and this is the way to think about it, is it a good news transaction, is it a bad news transaction? If you've got a good news transaction A good news transaction will be, I've made a sale for £100 for cash. Okay? What that now means is, I've made a sale for £100, so I'm going to credit sales. That increases my profits. So credit sales increases profits, because retained profits is a credit balance. If it's a credit balance, that's a good idea. So credit sales shows good news. An increase in assets, that's also good news. Debit cash. So you debit cash to show the increase in the assets, you credit sales to show the increase in profit. Does that make sense? There's my duality, that's my balancing act. Every single transaction can be shown in one of these 4 lines. Okay, so every single transaction can be shown in one of these 4 lines. Okay, we happy with that, guys? Fantastic. I've actually seen people, and this is really sad, I've seen people who've been qualified for a number of years with that on a yellow sticky stuck to the side of their computer screen to make sure they remember which side debits and credits go on. Okay, that is so powerful. If you go away with nothing today, make sure you go away with that, because that is going to make sure that you know everything to do with accounts from here on in. Now, another way of looking at this, and there's lots and lots and lots of different little mnemonics you can use here. Some of you may have heard of deal clip, deal click. There's various different other things you can fire in there. I don't like those mnemonics because it's just so, there's too many of them to start with. And the other issue I've got with that type of thing is sometimes there's L's on both sides and sometimes there's C's on both sides. And you know, I don't like that because that's just designed to confuse me. But what I do like is pearls. These are what we call pearls of wisdom. This was actually a friend of mine. His wife was doing AAT donkeys years ago, and she said, "Oh yeah, do you use pearls when you teach him?" She's like, "No, never heard of that one." So she came up with this and said, "This works." And from here on in, we've always taught using pearls. Okay. So what this what it stands for is purchases, expenses, assets. So if you've got a debit balance, you've either got some sort of asset that you've purchased or some sort of asset which is increased in value. Well, that's okay because that works with that type of increase in asset. You've got some sort of expense which ties in with that expense quite nicely, or you've got some sort of purchase. And what that now shows me is when I'm doing my debits and credits, if I'm purchasing inventory or stock to sell on, when you first purchase it, show it as purchases. Purchases are a type of expense. So these two things go together. So if you're taking FFA, when you do the debits and credits for purchases, show it as an expense. You then have an adjustment for your closing inventory at the end of the year, which will then force the closing inventory into the asset side of your balance sheet and then also into the cost of sales calculation. Does that make sense? No? We'll go through it in more detail later. With regard to my R stuff, what we have is revenue, which is another way of expressing sales. We also put in sales down here as well, which is a clear way of expressing sales, and also liabilities. Okay, so from a pearls perspective, we can look at all of these different types of transactions and we can shoehorn them into this type of pearls issue. Okay, so we can look at every single different type of transaction and we can just shoehorn them into pearls. Does that make sense? Fantastic. Right, let's have a look at example number 1. And if you go to page 14 within your packs, what you've got is our first example. Now what we've got here is a shed load of various different transactions. What we're going to do is we're going to process the debits and credits. As we go through and process these debits and credits, I need you to think about the impact on the balance sheet, think about the impact on the profit and loss account. Think about the debits and credits based on that wonderful big T account, think about it based on pearls as well. Okay, so let's have a look at the first one. We've got a sale for £100 cash. Debits and credits. The debits and credits based on this wonderful big T account, we've got an increase in an asset which is cash. So we're going to debit cash. So we debit cash to show the increase in the asset. We then credit sales to show the increase in sales. Does that make sense? So I'm going to debit cash and then credit sales. So debit cash, £100, and this will show the increase in the asset of £100. We will then credit sales, which shows the increase in revenue of £100. Does that make sense? There's my debit, there's my credit. Notice how this credit is indented. Because this credit is indented, what I could potentially do is I could actually superimpose over the top of this a T account, which shows that debits go on the left, credits go on the right. Okay? It's just one of the accounting conventions that we have. So you always indent credits just because that's the way we can superimpose a T account. Okay? Does that make sense to everybody so far? Yep? Cool. Second transaction. We've got a sale on credit for £150. What I'm going to do now is I need to work out the debits and credits. Okay, so I need to work out the debits and credits. Well, the credit side of things is still going to be sales. So I've still made some sales. So what I can actually do is I can process credit sales to show the increase in revenue, which will be £150. Now what I need is a debit of something for £150. The debit will have to be, is this good news as a transaction? Yes. So the debit, because it's a good news transaction, the debit has to go through to some sort of asset. That debit will be through to receivables, also known as debtors. So that's people who owe me money. That's an increase in my assets. So that's a good news transaction as well. Okay, does that make sense? Now notice the effect on the balance sheet and the profit and loss account. This asset is going to affect my balance sheet. That sales figure affects my P&L. Notice the way the shorthand works here. So BS for balance sheet, nothing else. P&L for profit and loss. That increase in sales there, that goes into my P&L. That increase in assets, that goes through to my balance sheet. Okay, does that make sense? This is the double whammy impact of all of my transactions. Okay, so this is the double whammy impact of all my transactions. Are we happy with that, guys? Cool, right, let's keep on trucking then. Let's do some more transactions. Transaction C, we're going to purchase of £80 for cash. So we've got purchases for £80. Okay, what's going to happen to my cash balance? Is cash going to go up? Is cash going to go down? Down. Cash is going to go down, so that's bad news with regard to cash. So what I need to show here, according to my debit and credit structure up here, if cash is going to go down, I need to show a credit on my cash account. Okay, so I need to show a credit on my cash account to show that cash as an asset is now going to decrease. Does that make sense? So cash as an asset decreases, so I'm going to credit cash. So credit cash shows the decrease in the asset to the tune of £80. What I'm then going to do is I'm going to debit purchases, which is actually an increase in expenses to the tune of £80, because that's now going to become part of my cost of goods sold. Okay, does that make sense? So that credit to cash, which decreases my assets, that hits my balance sheet. That decrease in cash is now has another side, which is an increase in expenses. That will decrease my P&L account. Notice that the debit into the P&L is bad news. So the debit into the P&L is bad news because we want the credit figures in the P&L to show good news. Notice how credit figures on the balance sheet, they're the bad news. So this is actually a bad news transaction. We've had to spend some money on something that we have not made any profit from it yet, but we might make some profit later on. Does that make sense? Fantastic. Right, what that means is the next transaction we have will be, we're going to purchase stuff for £125 on credit. So purchases for £125 on credit. Well, now I can't credit cash because I don't have any cash to pay out yet. I haven't paid for it in cash. What I'm going to do is I'm going to credit payables, and I'll put a love note here saying these are also known as creditors, and this is an increase in liabilities. So that's an increase in liabilities to the tune of £125. And what I'll then do is I will debit purchases, which will be an increase in expenses to the tune of £125. Oops. Does that make sense? Okay, let's put this into balance sheet and P&L figures. Payables goes into my balance sheet. It shows an amount I have to pay sometime in the future. These purchases, they go into my P&L. That's going to become part of my cost of goods sold. Okay, does that make sense? We're all happy with that so far? Fantastic. Right, let's keep on trucking then. Let's have a look at the next transaction. So the next one is we're going to pay the electricity bill and we're going to pay out £50. So we pay £50 to the MUA. Okay. What happens to cash? Increase or decrease in cash? Decrease in cash. So should that be a debit or a credit to my cash account? So it should be a credit because it's a decrease. So I'm going to credit cash, which is a decrease in the asset. And I'm going to credit cash to the tune of however much the transaction is, which is £50. I'm then going to debit. What am I going to debit? It's going to be some sort of expense, isn't it? So I'm going to debit electricity expenses to the tune of £50. Does that make sense? So what we've got is the impact on the balance sheet is bad news. The impact on the P&L account is bad news. So a credit to the balance sheet is bad news. A debit to the P&L account is bad news. Okay, does that make sense to everybody? Fantastic. Next transaction. We're going to receive £105 from our debtor. So if I go back up to our previous transactions, what we've got is this sale on credit for £150. We're now going to get £105 in from that person. Okay? So we're going to get the £105 in from that person. So they still owe us £45. So we get cash received from a debtor. So this guy owes me some money. If the cash is going to be received, what's the impact on my cash account? Debit or credit cash? Debit cash. Debit cash to show, oops. So debit cash to show the increase in cash, and I'm going to get £105 in. I've already made the sale and this person owes me some money. So what I'm now going to do is I'm going to credit receivables, which will show a decrease in the asset to the tune of £105. So that gives me a balance sheet effect. That gives me a balance sheet effect. Does that make sense? That means there's no impact on my profit and loss account. So when I receive money in from these people, there's no impact on the profit and loss account. When did we have the impact on the P&L? The profit and loss account was impacted when we made the sale, not when we collect the cash. So when you make the sale is when we hit the P&L account. And when we hit the sale was much further up here. When we made our sale here for £150, that's when the profit and loss account was impacted upon. Does that make sense? So when you make your sale, that's when you can show the profit. You don't need to collect the money in to show profit, which shows me one of the issues we've got with these types of financial statements. I can show profits, which will be different to cash flows, which is why we have to do a cash flow statement as well. So profits are different to cash flows, okay? And that can be really important to me. Next transaction, so moving on down. So we've now got £105 in from that debtor. We're now going to pay out £125 to a creditor. So when we pay out this £125 to a creditor, what's going to happen to cash? Cash go up, cash go down. Cash goes down. So debit or credit to cash? Credit cash. So credit cash to show the decrease in the asset to the tune of 125. I will then debit payables, which will show a decrease in the liability to the tune of 125. Both of these are balance sheet accounts. So both of these are balance sheet accounts, which means that there's no effect on my profits. The profits were affected when we bought the stuff and then tried to sell it. Okay, does that make sense? Fantastic. Right, let's keep on trucking through. What we've then got is we're going to borrow 10 grand from the bank. Okay, so we're going to borrow 10 grand from the bank. What happens to my cash at bank account? Well, my normal deposit account is going to go up. So I'm going to debit cash to show the increase in the asset to the tune of 10 grand. Happy days. But then I have the credit thing. The credit balance is going to go to bank loans, which will be an increase in a liability. That increase in the liability will be a long-term liability. So it'll be a long-term liability, so it's just shown on a different part of my balance sheet. So both of these entries now hit my balance sheet. Does that make sense? Any impact on profit yet? No, no impact on profit yet. What would be potentially the impact on profit here if we had some sort of interest to pay? Okay, so let's add on an extra transaction here. If in 1 year's time, the interest of, let's say 4% was due, that now means that I've got to pay 4% multiplied by the 10 grand as interest, which means I've got to pay £400 worth of interest. Does that make sense? What's going to happen to cash? Cash is now going to decrease because I've got to pay £400 over. So I'm going to credit cash, which will be a decrease in the asset, £400. What I will then do is I will debit an element of expense, and the expense will be interest expense, which is £400, and that interest expense will go to my P&L account. The decrease in cash goes to my balance sheet. Does that make sense? Right, I want to give you another little example because we were chatting about the idea of cost of goods sold and such before. On the face of my profit and loss account, what happens is the face of the profit and loss account starts off with sales, and we'll have an amount for whatever the sales are. And then what we need to do is we need to work out what our cost of sales are going to be. Okay, so we've got a sales figure of however much. From that, we will then deduct cost of sales. Cost of sales are made up of various different components. And what we have is opening inventory or stock. We then add in any purchases we've made during the year, and then we subtract any closing inventory. Okay, does that make sense? And then what will happen is we'll have these numbers in here. By convention, if you see a number in brackets, it means it's a negative figure. So that means that's the negative. When we then add those three things down together, we end up with a total negative figure of whatever my cost of sales are, and then that will allow me to work out my gross profit. Okay, we happy with that? Let's put together an example to illustrate what's happening here. If we bought 500 pens for £1 each and sold 300 pens for, how much are we going to sell them for? Let's say we're selling for £3 each. Okay, that means at the end of the year, so at the end of the year, we've got 200 pens left over. Okay, does that make sense? From a common sense perspective, I've sold 300 pens. How much profit do I make per pen? Well, I've sold them for £3. They've cost me £1, so I should be making £2 profit on each of them. So I should be hoping to make £600 worth of profit. Does that make sense? Let's process the debits and credits to make sure we actually end up with that type of figure. So what now happens is, we've bought the pens for £1 each. Let's say everything's going to be a cash transaction. So we're going to credit cash to the tune of £500, because that's how many we've bought. We then debit purchases to the tune of £500, because that's what we've bought. We then make sales. So I'm going to debit cash to the tune of, I've made 300 pen sales at £3 each, which means I get 300 by 3, which is £900. And then I'm going to credit sales to the tune of £900. Does that make sense? We need to force this figure to come out as £600 worth of profit. 900 minus 500 does not equal 600. The numbers are different. Something's gone wrong. So what we have is at the year end, we process an additional adjustment. This additional adjustment will be for my closing inventory or my closing stock. And what we do is we debit closing inventory in the balance sheet. And we debit the closing inventory to the tune of, I've got 200 pens multiplied by £1 each, which means I'm going to debit £200. What I then do is I will credit closing inventory in the P&L account to the tune of £200 as well. Okay, does that make sense? Right, let's put them into the P&L account and actually see what gets kicked out the other end. Hopefully this will come out at £600 worth of profit. So what we now have is sales. The sales that we've made are £900 worth of sales. That's a credit balance. Okay, £900 worth of sales, that's good news. Then what we do is we take off our cost of sales. And our cost of sales will include, it's cost me £500 to buy these things, and I'm going to say we've got no opening inventory. So opening inventory is going to be 0. Then I'm going to add on any purchases. The purchases that we made were £500. Whoops, £500 worth of purchases. Does that make sense? That is a debit balance. What I then do is I take off my closing inventory. The closing inventory is that figure there, which will be a credit balance. So that figure becomes a negative figure, which is why I'm going to put it in brackets. Does that make sense? What I can then do is I can total this down. I can say that I've got 500 debits with 200 knocked off, gives me a total cost of sales of £300, which means that my cost of sales of 300 gets knocked off my 900, which gives me my expected gross profit of £600, which is a net credit balance. Okay, does that make sense? That's why whenever you process purchases, you always dump them into an expense-based account, and that's why we have our stock count at the end of the year. Okay, we all happy with that, guys? Fantastic. Right, next thing I want to have a look at. We're going to look at these T accounts and how these things get balanced off. Now, I'm going to talk about the idea of balancing these things off manually to start with, which is a bit of a bind because, to be honest with you, the last thing you want to do is sit there balancing off every single T account you've got in your set of accounts, because you could have hundreds and hundreds of these T accounts. So what generally happens is your computer system will do it for you automatically. Okay? But what I'm going to do is I'm just going to go through exactly how your computer system actually does it so you can understand exactly what goes on here. Example number 2 illustrates how this works. So with example number 2, what we've got is nice big T account. This great big T account is going to be for cash. So it's a balance sheet T account. So this is cash, which is a balance sheet account. I've got my debits on the right, I've got my credits on the left. So on the 2nd of the 1st, we've made some sales of £500. On the 10th of the 1st, we've made some sales for £500, nice and even and average. On the 1st of the 1st, we've got some purchases, which we've had to pay for in terms of cash, which is £300. And then on the 25th of the 1st, we've got the telephone bill, which is going to come in at an extra amount of £50. Okay? What we need to do is we need to work out exactly how much cash we've got at the bank. So what we're going to do is we're going to subtotal these down to start with. And whichever one comes out as the highest is going to be basically my total. So we end up with 1,000 to start with on the debits. We end up with 350 on the credits. What we then do, or what your accounting software package will do, is it totals these down to the higher of those two figures. Now, 350 doesn't equal 1,000, so there must be an additional adjustment there. So what happens is we have the balance that will be carried forward, and it'll be the difference between 1,000 and the 350, which gives me a 650 balance. Okay? What then happens is that becomes my balance, which will then be brought forward of 650. And it's that double entry which allows these different T accounts to balance down just to one number. Now, your accounting software package does this automatically. Okay? But if you're doing FFA, you have to do this lots of times, which is a real bind. Okay? And what that now means is I expect to have 650 debits. Debits are good news to me. Debits are assets. So I would expect to see £650 in my bank account. Does that make sense? So I'd expect to see £650 in my bank account. And when you do your bank rec at the end of every month, that's the figure we're going to reconcile to. Okay? So when Sheila does all our bank recs, that's what she's reconciling to. Does that make sense? Where's the downside with this type of reconciliation out to this one single figure? If you've got money in the bank, what type of balance does the bank statement say you have? The bank statement that you get from the bank, what does it say? Debit or credit? It's a credit. What the bank statement does is it gives you an extract of the bank's balance sheet. So the bank is saying, you're a creditor, I owe you the money. We're saying, that's my money. That's why the bank does everything backwards for us. So when you do a bank reconciliation, always remember that debits and credits need to be switched around on the bank statement, just because this game isn't complicated enough. Okay, are we happy with that, guys? Fantastic. Okay, that brings me up very nicely to the end of chapter number 3. Any questions or queries there, guys?